Active income. Active income refers to income from the remaining of some services for fixed income such as wage, including bonuses, tips, and commission. Active income also applies to the profit of the companies in which there is significant participation in running such business. Other income. Other income is an income that does not come from a company's main business, such as interest. Examples of other income include income from interest, rent, and gains resulting from the sales of fixed assets. Companies present other income in a separate section before income from operation. There are three income taxation schemes under the NIRC. So the first is final income taxation. So final income taxation is characterized by final taxes wherein full taxes are withheld by the income payer at source. The recipient income taxpayer receives the income net of taxes. The payer is the one required by the law to remit the tax to the government. Consequently, the recipient income taxpayer does not need to file income tax return because the withheld tax constitution the full tax due and order for the final payments. Second, capital gains taxation. Capital gain tax is imposed on the gain realized on the sales, exchange, and other disposition of certain capital asset. Third is regular income taxation. The regular income tax is the general rule in income taxation and covers all other income, such as active income and other income. Of items of gross income. Because of the different tax scheme, items of gross income can be classified as follows. Gross income subject to final tax. So, tax rate from income subject to final for resident and non-resident aliens engaged in the trade of business in the Philippines. The maximum rate of income subject to final tax is usually passive investment income is 20%. For non-resident aliens not engaged in the trade of business in the Philippines, the rate is flat 25%. Gross income subject to capital gains. Capital gains taxes are levied on earnings made from the sales of assets like stock or real estate. Based on the holding term and the taxpayer income level, the tax is computed using the difference between the asset sale price and acquisition price and the subject to different rates. Income versus active income. Passive income are earned with very minimal or even without active involvement of the taxpayer in the earnings process. Example of passive income: interest income from banks, dividends from domestic corporation, and royalties.
Accounting period is the length of time over which income is measured and reported. Types of accounting periods. Regular accounting periods. 12 months is length, calendar, and fiscal. Short accounting period, less than 12 months. Calendar year. The calendar year accounting period starts from January 1 and ends December 31. This accounting period is available to both corporate taxpayer and individual taxpayers. Under the NIRC, the calendar year shall be used when the number 1. Taxpayers' annual accounting period is other than a fiscal year. Number 2. Taxpayer has no annual accounting period. Number 3. Taxpayer does not keep books. Number 4. Taxpayer is an individual. Fiscal year. A fiscal year accounting period is any 12 months period that ends on any day other than December 31. This fiscal account period is available only to corporate income taxpayer and it's not allowed to individual income taxpayer. Dealing of filing an income tax return. Under the RC. The return is due for filing on the 50th day of the fourth month following the close of the taxable year of the taxpayer. The regular tax due to payable upon filing of the income tax return. Due date of an annual income return. Number 1. Taxpayer under the calendar year must file their annual income tax return for the current period not later than April 15 of the following year. Number 2. A corporate taxpayer with fiscal year ending June 30, 2019 must file an annual income tax return not later than October 15, 2019. Initial payment means total payments by the buyer in cash or property. In the taxable year the sale was made, the term initial payment is broader than down payment. It also includes the installment payments in the year of sale. Installment methods. Under the installment methods, gross income is recognized and reported in proportions to the collections from the installment sales. Installment method is available to the following taxpayer. Number 1. Dealers of personal property on the sales and properties they generally sell. Number 2. Dealers of real properties on if their initial payment does not exceed 25% of selling price. Number 3. Casual sales of non-dealers in property, real or personal, when their selling price exceeds 1,000 and their initial payment does not exceed 25% of selling price.
Next one is accounting methods. Accounting methods are accounting techniques used to measure income. These are the rules or procedures that companies use to record and report their financial transactions. These methods help companies keep track of their money, assets, and debts. They include things like how to categorize expenses, when to recognize revenue, and how to calculate profits. Different accounting methods can affect how company financial statements look and how they are interpreted by investors and regulators. Now, let's go to the two general methods and types of accounting methods. The first one is accrual basis, and the second one is cash basis. But now, let's focus first on accrual basis. Under the accrual basis of accounting, income is recognized when earned regardless of when received. Expense is recognized when incurred regardless of when paid. Or in simple terms, accrual basis, you count transactions when they happen, not just when money changes hands. So, if you do work for someone today, even if you don't get paid until later, you still record it as income today. It's like keeping track of what you're owed, not just what you have in your pocket right now. Now let's go to cash basis. Under the cash basis of accounting, income is recognized when received and expense is recognized when paid. In simple terms, cash basis, you count money when it comes in or goes out. So if you get paid today, you record it today. If you pay a bill today, you record it today. Here are some basic examples in cash basis and accrual basis. So in cash basis, let's say you're a photographer and you take wedding photos on December 31st. The couple pays you 10,000 pesos in cash on January 5th of the next year. With the cash basis, you record the 10,000 pesos as revenue on January 5th when you receive the cash. So in accrual basis, using the same example, with the accrual basis, you would record the 10,000 pesos as revenue on December 31st when you actually took the photos, even though you haven't been paid yet. So, even though you didn't get the money until January, you record the income when you earned it. Let's go to selling price. Selling price means the entire amount for which the buyer is obligated to the seller. or it is how much you charge someone to buy something from you. It's the amount of money someone has to pay to purchase a product or service. For example, let's say you have a bicycle that you want to sell. You decide to sell it for 5,000 pesos. That 5,000 pesos is the selling price of a bicycle. If someone wants to buy a bicycle from you, they would need to pay you 5,000 pesos to take it home. Now let's go to the contract price. The contract price is the amount receivable in cash or other property from the buyer. It is usually the selling price in the absence of an agreement whereby the debtor assumed indebtedness to the property. For in simple terms, contract price is the amount of money agreed upon in a contract. It is the price that both parties agree to pay or receive for goods or services in a legally binding agreement. For example, if you sign a contract to buy a car for 150,000 pesos, then the 150,000 pesos is the contract price.
So, what is a deferred payment method? A deferred payment method is variant of the accrual basis and is used in reporting income when a non-interest-bearing note is received as consideration in a sale. Under the deferred payment method, the gross income is computed based on the present value or discounted value of a note receivable from the contract. The discount interest on the note is amortized as interest income over the installment term. Let's say on December 31, 2019, a taxpayer sold an office building costing 1,400,000 pesos for 2 million pesos. The buyer made 1 million pesos down payment and the balance evidenced by a note is due in 2 annual installments of 500,000 pesos. Every December 31 starting December 31, 2020, note that the installment method cannot be allowed since the ratio of initial payment is already 50%. Assume the note is not interest-bearing that can be discounted at a local bank for 900,000. Under the deferred payment method, the reportable gross income for each year shall be. So, on 2019, the cash rent payment is 1 million pesos and the present value of the note is 900,000 equals to the selling price of 1,900,000 pesos. And the last tax basis of the property is 1,400,000 pesos. And the gross income is 500,000 pesos. The installment on 2020 and 2021 is 50,000 pesos. Under Revenue Regulation Number 2, the income from leasehold improvements are reported using either of the following method at the option of the taxpayer. Number 1. Outright method. The lessor may report as income the fair market value of such buildings improvements subject to the lease at the time when such building improvements are completed. Number 2. Spread out method. The lessor may spread over the life of the lease the estimated depreciate value of such buildings or improvements. As the termination of the lease, report as income for each year of the lease and any cut part thereof.
The depreciated value of the leasehold improvement is computed as cost of improvement times excess useful life over lease term and useful life of the improvement.
Let's say on January 1, 2020, Anderson leased a vacant lot to Greg under a 20-year lease contract. Greg immediately constructed a building on the lot at a total cost of 4,500,000 pesos. The building has useful life of 30 years. Under the plain wordings of Section 49 of Revenue Regulations Number 2, Anderson shall recognize the entire 4,500,000 fair value of the improvement as gross income upon completion of the improvement in 2020. This is not income in its totality, but this is the amount referred to by the regulation. The depreciated value of the property at the termination of the lease is the value of the years of usage of the lessor. This can be computed by splitting the value of improvement as follows. Since the building has useful life of 30 years, a 20-year lease divided by 30 times 4,500,000 is equals to 3 million cost. If a 10-year lease divided by 30 times 4,500,000 is equals to 1,500,000 cost. Total of 30-year lease, the total of 30-year lease is equals to 4,500,000 pesos. What is hybrid basis? The hybrid basis is any combination of accrual basis, cash basis, and or other methods of accounting. It is used when the taxpayer has several businesses which employ different accounting methods.
I will be recording the tax report. We will choose types of returns to the government. There are three types of it: income tax returns, withholding tax returns, and lastly is the information returns. We will tackle first about the income tax return, which provides details of taxpayers' income, expenses, tax due and tax due, tax credit, and tax still due to the government, which impose the annual income tax. Returns summarize all the transactions covering the calendar year of the taxpayer. This return shall be filled by the following individuals regardless of the amount of gross income. Second one is withholding tax return. Provides reports of income payments subjected to withholding tax with the taxpayer, withholding agent. It encourages voluntary compliance. It reduces cost of collection effort. It prevents delinquencies and revenue loss. And lastly, it prevents dry spell, the fiscal condition of the government by providing revenues throughout the taxable year. Lastly is the information returns, which impose the annual information return is a tax document used for reporting certain transaction to IRS. IRS stands for Internal Revenue Service. As per the IRS and related regulation, filing information returns is mandatory for all entities undertaking reportable transactions. Mode of filing income tax return. There's a three of it also. Manual filing system is number 1. Number 2 is BIR forms. Then lastly is electronic filing and payment system, EFPS. We'll tackle first about the manual filing system, which is number 1. The traditional manual system of filing income tax return is by paper documents, where the taxpayers will appear BIR forms to report income, expenses, or any declaration required to be filled with BIR. Under the NIRC, the income be filled to the following in descending order. Under the NIRC, the income tax return shall be filled to the following in descending order of priority within the Revenue District Office, where the taxpayer is registered or required to register. Under the NIRC, the income tax return shall be filled to the following in descending order of priority within the Revenue District Office, where the taxpayer is registered or required to register. Number 1 is an authorized agent bank, AAB. Number 2 is revenue collection officer. Then lastly is the duty authorized city or municipality treasurer if there is no BIR office in the locality. Well, number 2 again is e-BIR forms. The BIR introduced the e-BIR forms with an offline or online version. Taxpayers fill out their income tax return and electronic spreadsheets without the need of writing on papers. This will competitiveness The system ensures completeness of data on the return is capable of online submission. If there are no penalties that require VIR assessment, taxpayers would have to print a hard copy of the field tax returns and proceed directly to the bank of payment. Electronic Filing and Payment System EFPS. The last one, the EFPS is the paperless tax filing system developed and maintained by the BIR. Taxpayer file tax returns including attachment in electronic format and pay the tax through the internet. Penalties for late filing or payment of tax. The late filing and payment of tax is subjected to the following additional charges. Number 1 is the surcharge. Number 2 is the interest. Well, number 1 is the surcharge about A and B. I got it. Penalties for late filing or payment of tax. The late filing and payment of tax is subjected to the following additional charges. There's two types of charges, is the surcharge, then number 2 is the interest. Number 1 is the surcharge, then the two mode of it. 25% of the basic tax for failure to file or pay deficiency tax on time. Then the last mode of it is 50% for willful neglect to file and pay taxes. The non-filing is considered willfully neglect if the BIR discovered the non-filing first. This is the case when the taxpayer received a notice from the BIR to the file return prior to his actual filing. If the taxpayer filed a return before the receipt of such notice, the same is considered simple neglect subject to the 25% surcharge. Last charge of it is the interest. Interest is the double of the legal interest rate for loans or forbearance of any money in the absence of any express default. Number 2 is the interest. The interest is the double of the legal interest rate for loans or forbearance of any money in the absence of any express stipulation. Since the legal interest is currently set at 6%, the interest penalty is therefore 12% per annum, effective January 1, 2018. Note that the NIRC imposed an interest penalty of 20% per annum until December 31, 2017. Under the new rules established by RR 1221/2018, the interest period shall be computed based on actual days divided by 365 days. The additional day in February during a leap year will be counted. The yearly monthly daily counting method established in prior regulation is already abandoned. A month normally have 30 days except the following. One will be the 31-day months: January, March, May, July, August, October, and December. Then the 28 or 29-day month, which is the February. The best way to put this in mind is the 31-day and the 30-day months are alternating from January to July. But the sequence is the receipt in August. Also put in mind that the February is a 28 month except on a leap year.